The following program is paid for by EG Tax. All opinions or statements expressed on this program are solely those of EG Tax or its guests and do not reflect the opinions of News Radio 930 WBEN or Odyssey.
This program has been pre-recorded.
Hi, this is Esther Golias, the tax lady from EG Tax, and I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey, how's it going today?
Good, and Christopher Fabian.
Hello, Esther.
And so, today we're not taking phone calls. We're going to do emails today. So I think you should listen. I think you're going to find it interesting because we go into depth and show you just exactly how some of the tax decisions we make are founded. And so we think you'll find it interesting. By the way, don't forget that we have our tax school coming up starting in October. It's a tuition-free school. It is absolutely a dynamite course. Teaches you everything about the federal and state income tax system. And for our successful graduates, we offer employment. So again, our tax school, you can do it. You can register online at egtax.com. Or you can come down to our corporate headquarters at 1890 Colvin in Tonawanda. But I'm going to tell you, you will really, really enjoy the class. And it's all adults.
So you can even call us at 632-7886 and register over the phone. We have classes Fredonia, Angola, Orchard Park, Amherst, Tonawanda, Niagara Falls, Lockport, you name it, we have it by you.
And it's on the computer, so you don't have to say, "Oh, I don't think I can do math anymore." It's all computerized, but you don't have to worry about being proficient at computers because really, the program that we have is a phenomenal program, and it's very user-friendly. And as we teach you computers at the same time.
It's so cute, wonderful. It's a blessing. My daughter has come to work for us, and she's been out putting flyers up at college campuses and other big municipalities like hospitals about the tax school. And so it's just so wonderful to work beside Gracie.
Right.
Yeah. Love it.
Okay, and then the other thing we want you to put in your thinking cap, if you're somebody that says inflation has been eating away at your budget, many things can be done utilizing income in a smarter way so that you don't end up paying taxes on some of the money that you needed to take maybe out of a pension plan to make ends meet. And so we're having a seminar that's kind of an inflation-busting seminar to show you some of the things that you can do to improve your budget. And we're going to have experts. We're going to have a workshop. And again, that's another free service that EG Tax have. And you can do that on our website as well.
Correct.
Right? Okay, so just emails today, right?
Yep.
Correct.
All right, so what's our first one?
I could do one. I got Tom in Tonawanda. EG Tax, my wife is in a nursing home as a private pay patient. We have long-term care insurance, which pays for all of the bills. You have said there is a credit. Do we get it even though the expenses are covered under the long-term care policy? That is Tom in Tonawanda.
All right, so what do you guys think?
No, not if it's all covered.
I mean, if it's, one of the things in tax law, and it isn't always like this, but one of the things in tax law is if it's been reimbursed, unless you had paid for you had paid for it and they're giving you your money back, it is going to be a non-deductible item. So since the nursing home is paid for long-term with the long-term care policy, and it's an insurance policy, you aren't going to be able to double dip.
Right.
But there is something that does double dip. Can you think of an example of someone that double dips?
In regards to this?
No. In regards to...
sorry. I was thinking long-term care. Well, double dipping.
How about pastors?
Pastors, that's what I was thinking.
Yeah. So if you're a pastor and you're getting a housing allowance, which is tax-free, and you spend it on housing, you can still take the mortgage interest that you're paying in property taxes, and you don't have to pay taxes on the parsonage. So that's a way of kind of an enigma in the tax law.
Right, and they can use their regular expenses to offset the self-employment tax if
Right.
they elected to still collect Social Security, and then they get to also use it as an itemized deduction. So there's a lot of things pastors get to
pastors
do.
really do get preferential treatment in the tax code. And if you are a pastor and I had a pastor last year that came in and said, I can't find anybody that really knows how to do clergy taxes. Well, we really do.
And then I want to.
So if you are a pastor and you've been doing it yourself, or you aren't sure if it's been done correctly, give EG Tax a call. We'll be very happy to double check it for
And
you.
then let's say he doesn't have long-term care insurance and he was a private pay, you could take up to 6% of the assessment charges that the nursing home does charge, and you would do it on, is it a New York State 258? 258. So again, 6%, I think the nursing homes, they sneak in, 6.5 or 6.8 or something like that.
Right, there's a bed tax that New York State imposes, which they will give you back if you apply for it, because it really shouldn't be there.
Right.
And so if this were a private pay patient, but she's not,
Right.
then you would get, if you file the form 258, you would get thousands of dollars back. And so if you are somebody that had a loved one in a nursing home and it was private pay, and you've never applied for the refund of the bed tax that you paid, do it. You have thousands of dollars coming back.
Yep, and you can
per year
for 3 years.
Right?
Yeah. Also, I know I have clients, I'm sure you guys do too, that go, I used to pay long-term care insurance, but it's just the insurance itself has gone so expensive, I don't want to pay it anymore. Well, even if it is $5,000 a year,
Right.
how much is it a month in a New York
Like
State?
$15,000.
Right.
So it's like a quarter of a month that you're paying to avoid paying $15,000. It's like $180,000 a year. It's unbelievable. So if you have long-term care insurance, really, and really that's what Chris is saying, the risk, it's all risk and reward. The risk is completely going to bite you in the butt if you should end up having to go, either one of you, into long-term care and pay for it yourself.
Right. And I know, talking to some of my clients, you may be able to say, okay, I don't want the price increase, but I want to keep it. And they say, okay, well, we'll only cover you for 2 years, not 5 years.
Right.
So there may be other things.
In other words, you can negotiate an adjustment to the policy.
Exactly.
Okay. All right. So that's one question. What else we got?
We got Ben writes in. This seems like a very common one this year. I don't understand what happened to my refund this year. It was only $153 from the federal. It is usually around $1,800. My job is the same and nothing changed. I'm single, I rent, and no kids.
But something did change, didn't it?
Yeah.
The withholding charges
The
changed.
withholdings, yep.
Mm-hmm.
And so if they and really they kind of snuck that out on people so that it looks like they got more money. And they did get more money. They just had less withholding. So when they were filing their tax return, they ended up with a smaller refund. So that's one of the things they should
How many
look
people
into.
got mad at us because of their refund size, and we had to explain this to them. But the thing is, too, did you make adjustments for this year?
Right. Well, here we are in September, right?
Yeah.
And if you were unhappy last year and you did nothing, probably you're going to be unhappy again. But if you need help, you can call EG Tax and we'll help you straighten it out with your employer. I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break. We'll be back on the other side with more answers to emails. Hi, this is Esther Golias, the tax lady. Thanks for listening to Ask the Tax Lady. This week, we're going to be answering emails that you guys have sent in, as opposed to taking live phone calls. So, and I think you're going to find it interesting because we kind of veer off on other related topics as well. But anytime you have a question, you can always go to our website at egtax.com, ask the tax lady, or call our corporate headquarters at 632-7886, or you can text us. I mean, we want to help you, and don't go it alone. If there's something that's going to happen financially, don't do it and then call us. Call us, then do it.
Yeah, and I just wanted to say about the last writer. Also, if your kids are turning over the age of 17, don't forget, instead of getting $2,000, you only get $500 a child. And so you're really going to want to make those changes and modifications as the kids get older, because some of the child tax credit drops
Right.
off.
So before the break, we had a question about how come his refund went down, and Tiffany's absolutely correct. When your kids turn 17, it majorly affects your tax refund.
Yeah.
Tax liability.
Yep.
Okay, what do we got, Chris? Tiff?
It says, Dennis, Esther Eingang, I'm still waiting for my refund. According to the IRS website, my return was received on March 29th, and it's still processing. Help, what should I do?
This is a big problem, isn't it?
This is a huge problem right
They're
now.
just not mailing out those darn refunds. They're not, and they're saying that it's all they're doing identity information before they mail it out. And if you, the taxpayer, have gotten a letter and you just thought, oh, this is not my refund, and you just threw it away, you have to contact the Internal Revenue and subject yourself to a kind of an inquisition to verify that, in fact, you are the person applying for the money. Failure to do that, what happens?
They're going to hold your refund, and all subsequent going forward refunds they'll hold
So
too.
here it is, September. We have the rest of September, October, November, and December before it's tax season again. If you did get that letter, or your refund's non-existent, give us a call. We'll make that call for you, right?
And I've seen it. This is the latest thing. People like maybe here, Dennis did get an identity letter, did verify himself, and he still doesn't have it. This is what we're seeing. We call the IRS and they go, oh, the person on our end didn't complete it right, so we have to do it again. So then,
and we just had a client the other day that we did it again, because that particular client, I already did identity with him because but now they're saying he has to appear in person.
Right. Yeah, so they keep changing it, how it goes. And on these letters, there's like a 15-digit control number that you have to give to the Internal Revenue Service, and if you don't have it, you can't verify.
Right.
So I think this is a great delay tactic, because you're done with it. What do people normally do? They throw away the letter because
true.
I did it. So now I don't have it. Oh, well, we'll mail you another one. It could take up to 2 to 3 weeks, which now delays it another 2 to 3 weeks.
Right.
You get the letter, which now they can say up to another 12 weeks to get your refund.
And I hate to say, but Chris reminds me all the time, if people have a balance due, we don't find these identity letters as much as whereas if people have refunds. So
That's true. Which is another thing that you should really think about. If you're somebody that says, I really don't want them holding my $8,000, you can change your withholding at work so you get that $8,000 as you earn it, so that at tax time there is a very small refund, and it won't hurt if they are holding up that $100 for 8 months, you know. But more than anything, contact EG Tax so we can help you to take care of these identity theft issues, because they won't send the money till you comply.
Right.
It's so funny. Chris was helping somebody the other day who had to prove his withholdings, and they kept saying for your W-2 and your W-2, and the guy keeps appealing it. He goes, I don't have a W-2. It's a 1099-R. And so Chris was on the phone for hours and hours and hours, and he kept telling the people, it's not a W-2. It's a W-2. No, his withholdings are on a 1099-R. And so Chris thought about him calling his congressman, but anyways, he should change his withholdings.
Actually, that's not a bad thing to do.
Yeah.
If you're really having a problem, contact your congressperson.
Yeah.
That they're in government. They're there to help you.
That's
right.
right.
You know,
Sometimes you talk to their aide, and stuff gets done.
Right. And I know dealing with the clients, and they get so frustrated, and they're like, why don't we just go to a flat tax? And they'll never go to a flat tax. First of all, we visited Europe. And their tax rate's 40%.
Right.
So imagine you make $30,000 and you owe the government $12,000.
And the other thing is, a lot of people don't even, because the tax code, though, is so confusing, and I understand people's frustration, they don't understand that many people, if not a very, very large percentage of the population, pay no taxes at all.
Yep.
Yeah.
Because of all the credit, especially
Or
if
they
they
get a
if they
bonus.
have minor children. Right.
They get refundable credit.
Should
Okay,
I do
what
Morgan?
else we got?
Morgan in Depew writes in, tax lady, I'm starting a new job making almost $100,000 a year. I have student loan debt of $45K, which is my biggest burden, but I want to purchase my own home. My family wants to give me the money to pay off the debt, but isn't that taxable? Would it be better if they loan me the money instead of a gift, or should they give me the money as a down payment on my home? I'm confused.
Okay. So she's starting a new job making almost $100,000. She's got student loan debt of $45,000, and her family wants to give her the money to pay off her loan.
Yep.
So if you get a gift, is it taxable to you?
No.
Nope.
No. So if somebody gives you a gift, say thank you and pay off your debt.
Yep.
Now, the people
Exclusion is
gifting you,
$18,000 a year.
all right, are limited to $18,000 per person per year, or else they have to file a gift tax return.
Right.
Right? So they may end up having to file a gift tax return, but they won't pay any taxes.
Right. So Morgan, if both your parents are alive, they each could give you $18,000 this year. So that's
And this being September,
$36,000.
right?
Right. That's $36,000. You're down to $9,000. Then in January they give you just the other $9,000, and there you go.
And they don't have
no
to file a gift tax return. It's not taxable to you. And you can go and buy your house with no debt.
So break it down. One of the answers to the question, would it be better to have a loan than a gift? Take the gift. And my family wants to give me the money to pay off my debt, but isn't that taxable? The answer is no.
Nope.
And should they give me the money as a down payment on the house? It doesn't make any difference.
Well, so here's the thing. If, with interest rates fairly high
Right.
on mortgages right now, do you know what the interest rates are on student loans, Tiff? You might know.
It's about 8 or 9%.
All right, so if you can get a 5 or 6% mortgage versus an 8% student loan debt, you'd obviously want to pay off the higher percentage debt,
Right.
which is the student loan.
Plus, when you go to get a mortgage, if you don't have the student loan debt, you may be able to afford a house.
That's correct. A more expensive house.
Right. Or, nowadays a $100,000 house is going for $250,000.
Right.
But that not having that $45,000 on your credit report does free up your income,
Which probably would get you a better rate, right?
Right. So
yeah, I would say, and I'm glad, Morgan, that you wrote to us, because it's good to get counsel before you say, no, Mom and Dad, I'm going to take that $45,000 and use it as a down payment, as opposed to paying off your student loan debt.
Right. And of course the mortgage company is going to say, how did you get this money? And your parents are probably going to have to write a gift letter for the mortgage company.
Right.
Which doesn't cost you anything, doesn't cost them anything. It's just telling the mortgage company that extra money that just got deposited in your account was a gift, not
Right.
a loan.
Okay, what else we got here?
Terry in Williamsville writes in, tax group. During the big stock turndown in August, I lost $100,000 in my investments. But before that, I was up over $200K. Do I still have to pay taxes on the entire gain, or wait till I sell them? So
Well-
let's wait until you sell them.
Yeah, because right now it's called what's classified as an unrealized gain and an unrealized loss. So you don't pay tax on anything right now.
Right, because you haven't sold anything.
Right.
However, what he didn't mention, is this a he?
Terry. Could be either
Could
or.
be, but this person, Terry, might have large dividends, qualified dividends, right?
Correct.
And maybe if you're looking at a loss, you might want to sell some of your losers and buy it back in 31 days so that you can offset your capital gains for your qualified dividends with your capital losses. That might be something you'd want to look into.
Right. There's definitely, you got to look at what's going on in your portfolio. And did your broker sell anything?
And, that's a really good point, Chris. A lot of times people hand the money over to the broker's buying and selling, and you don't know that. So you think you haven't sold anything. You really have to check with your broker and do your due diligence and find out. And now's the time of year to do something.
Right.
Because we're in the fall. I can't believe we're in fall, but we are in fall. But we're in fall, and you only have like 3.5 months to, make some moves that'll save you tax dollars.
Right.
And that's really what we keep talking about, is we want to save you tax dollars.
Exactly.
All right, I'm Esther Golias, the tax lady from EG Tax. We're answering emails today. We're not taking any phone calls, but we are going to break for news, and we'll see you on the other side. Thanks for listening. We'll talk to you later. In studio with Tiffany Fabian, Christopher Fabian, and we're chewing up your emails that you have sent to us, and hopefully that'll give you some impetus to do something this fall before it's too late, because once January 1st comes, you cannot, except for IRAs and SEPs, you cannot do anything else to affect your tax refund and liability. So if you need help, if there's something that kind of hits your hot button here that we're talking about, give EG Tax a call. There's no charge for us to talk to you and make sure that you're on the right foot.
Right. I want to go back to Terry for a second. Couple things. Go through your portfolio. Make sure, like you said earlier, maybe your broker did buy and sell stock. You got to look so you know what's going to happen to you come tax time. But while you're looking through that portfolio, make sure your stockbroker has your right basis. Because
what is that?
What you paid for it and what was reinvested over the time. Because prior to 2011, brokers didn't have to keep track.
Right.
So they may just put down that, Esther, you sold Disney stock and there was no cost basis. So you got to pay tax on $100,000.
But really, over the years, I might have had $300,000 in dividends that I reinvested, which means my basis then was $300,000 plus what I paid for it.
Exactly. So, that's a big swing, a $100,000 gain to a $200,000 loss.
Right.
Or did you, I know we're working with some people right now that inherited stock and their broker put down what the parent originally purchased it for.
Right.
That's incorrect. Mm-hmm. It goes to the date of death. When that person died, that becomes your value. And it's looking like that's a $200,000 swing for these people.
Right.
So that
and
means
that's
an
called
extra,
a stepped up basis.
Yeah, $35,000 in savings for tax purposes.
Right.
So definitely review.
But here's the challenge, I think. I think when I look at these portfolios and these monthly statements that just seem to keep coming and coming and coming, people don't know how to read them.
Right.
And so it's like a deer stuck in the headlights. They don't know what to do. Bring in your statements. We'll show you how to read them.
I laugh because they don't even like to mail you paper statements anymore. Everything is electronic, and that even makes it more difficult because then you just
You
skip
don't
by
even
the
look.
Email.
Well, I don't know. My broker sends me
Some
paper.
do. Well, it's like credit card
And
statements
paper
right now.
and paper and paper. Every time they make a trade, they send you
charge
something.
You a fee for
But
mailing
the
a
thing
paper.
is, if you don't know what you're looking at, you don't know what to do. And so it's really not as hard as some people think it is. It's really pretty simple.
Right. Right.
If you know what you're looking at.
Yes.
Okay, what else we got here?
Go ahead, Chris.
Crystal writes in, I have 2 questions. My children want me to put my house in a trust. Are there any tax consequences for doing this? Second, what happens if I sell the house and move to Georgia to be closer to them?
Well,
Then you wouldn't wanna
that's
put it in
where
trust.
you have to you need to work with an attorney who understands the real estate transactions of putting a house in trust. So I'm thinking it would probably be a life estate. But if you sell the house in a life estate prior to your death, then and it's no longer your house and it belongs to your children, guess who's going to pay taxes on the gain?
To children.
Right.
Yeah.
So don't go putting stuff away if you think you're going to be moving.
Right. And how old are you, Crystal? Because that has a big factor in it. Because when my clients come in and they're young, I'll say in their 60s, that's still very young.
Darn tootin' it is.
Is this your forever home? And they look at me like, what do you mean? Is this a house I'm going to stay in, or you're going to stay in for the rest of your life? No, it's too big. I'm going to sell it in 5 years. Well, don't do it on this house because
Don't do what, Chris?
don't put it in a life
Right.
estate or a trust
Right.
because the current rules are, as long as you live there 2 out of the last 5 years. If you're married, the first $500,000 is tax-free of the gain. If you're single, the first $250,000 is tax-free of the gain. So,
But once you put it in the kid's name, then the kids go back to your original basis with what you paid for it plus improvements. And if you sell it before passing away, that's how you have it listed, if the trust owns it or your kids own it, they're going to end up paying taxes.
Well, I have a question for you guys. What if she says, yeah, this is my forever home, and she puts it in a life estate, and then a few years later, she's like, I'm going to move to Georgia. What would be good advice for
They
her?
can gift it back to her.
right, switch it back to
Right.
your name.
Switch it back to your name. You lived in it for the last 5 years. Then if you sell it, it's not taxable again. You just have to make sure the right person, that the name is in the right person, the asset is in the right person's name. That's what I'm trying to say.
Correct.
Right. And I'm going to make this suggestion out there. You go to an elder care lawyer
Right.
to get this done. Don't go to a bankruptcy lawyer because they're your
Or
cousin.
or Uncle Stanley, who's been retired for 12 years and he's not really practicing law anymore. You want to make sure that what you want to happen will happen.
Right. And and
And it doesn't hurt to call us, right?
right.
We're not
right.
going to do the work, but we're going to make sure that if
You
do see
understand.
Uncle
Good
Stan,
references,
that
too.
we straighten it out before it's a closed case.
Yeah, and
But a thing that is so important is you can take that title if you did give it to the kids already and you really you maybe want to move to Florida, have them gift it back to you so you can sell it and not pay taxes, then buy your house in Florida. If that's your forever home, put the life estate on that.
And then what about if, unfortunately, mom passes away before she puts it in a life estate? And what if it was a home that was owned by mom and dad died 10 years before mom? Then we talk about a basis that's split in two. One is a stepped-up basis, and one is the other basis, the basis when the mom passed away. We got a split personalities going on there, right?
Yeah, so if your residence was owned jointly and the first spouse passes away, then the spouse that's still living inherits the first spouse's basis. She'll get, I'm thinking she shouldn't have used it like that, but they will get a stepped up basis on half. Then that gives an adjusted basis on the house. Then if she puts it in trust, and it's or life estate, upon her death there'll be a full stepped up basis. But if she dies prior to that, but if she sells it prior to that, then the only thing you'll do is you'll get a 50% stepped up basis plus the original cost that she paid plus improvements on half.
Right. And why would we keep mentioning this. I know we mention all the time life estate, life estate, life estate. Why would somebody put their house in a life estate?
Because it's really planning for nursing home.
Right. Right. And what blows my mind away is I get these calls from the children. Well, we're selling mom's house. It was in a life estate. And then we're going to, and we're, well, how long it's been in there? Oh, 10 years. Okay. We're going to end up using this money to pay for mom's nursing home. Well, you're defeating the purpose of what mom wanted. She wanted you to have
so that
the
she
money.
can go on Medicaid.
Right.
I mean, really, that's the only reason you're doing all this gifting is because people don't have the means to pay. Well, they might have the means if their home is worth something, but if you don't do any of this and you do go into a nursing home, then you're going to be a private pay patient, and it's going to cost a fortune, and that whittles away at the one big asset that you want to be able to give to your children.
Right. And Tiff, you might remember this. I'm sorry, my mind's drawing a blank right now. We just had Jeff Katz on a couple weeks ago, and he said New York State just passed, they're like the 27th state to pass the new thing where you can do not a life estate. It's something that doesn't protect the home from a nursing home, but it protects it from probate. You can put your kids on it. Do you remember what that was called?
Nope,
No.
I don't.
But there is a new
But
thing.
you can call Jeffrey
Jeff,
Katz.
Yeah, yeah, 633-3363.
Right. Jeffrey Katz, KATZ, is an elder care attorney specialist, all around good guy. And again, you cannot overthink your plan if you're trying to preserve the assets when you're getting older and you're thinking, if I go into a nursing home in 3 years, the entire asset is gone.
Very
Or 2 years.
heartbreaking. Yep.
Okay,
Yep.
what do we got?
I've got Sarah, tax lady. My daughter just got her first job part-time at a grocery store to help pay for her books at college. What should she claim on her withholding form at the grocery store? She doesn't want to owe money come April.
Well, I'm assuming she's not making much.
Well, part-time.
Right, but if she makes more than, what is it, $3,200 to the state of New York, she's going to have to pay New York state taxes. She won't have to pay taxes for the federal unless she's making over $12,000. So it's not a problem on the federal. It's a slight problem on the state, depending on how much she gets. But again, no matter what your question is, something as simple as what to claim at your employer, or as complicated as a corporation and BOIs and things of that nature, we will help you. So her name's Sarah, right?
Sarah. I would have her do withholdings just to be on the safe side, because this is what I find is parents or somebody will misguide them, or the person over the fence, and say, oh, you're exempt from paying taxes. And but the truth is her parents claim her. And so for New York state purposes and the federal, she loses her personal exemption. And so on New York state, she could be left holding the bag, and they just hate that.
Well, I was talking about New York State.
Yeah, you were.
But on the federal, I mean, unless she's making over $12,000, she's not going to pay any taxes.
Correct.
Right.
What do you think?
Yeah, I mean, I always tell the parents, well, have your kid do $5 federal and $5 state extra as a just in case, because let's face it, if the kid owes $120 to New York, who's going to pay that?
Mom and Dad are.
Mom and Dad are.
Right.
So this way, that
Absolutely.
saves mom and dad $120.
Well, and that's absolutely true.
And the kids think they're getting a refund.
Yep.
Right, absolutely. I'm Esther Golias, the tax lady from EG Tax. Don't forget our tax school starting next month. You can go to our website at egtax.com. We're just doing emails today. I'm in studio with Christopher Fabian, Tiffany Fabian. We're going to break for our commercials. We'll be back on the other side. Hi, I'm Esther Golias, the tax lady. We just appreciate you being part of our show. Today we're chewing up emails. I got Tiffany Fabian, Christopher Fabian here in studio, and we're answering your emails. So you wanted to say something
I wanted
about
to tell
Sarah.
a story.
A story.
A story. So I had this young girl come in, and she's 21 years old, in college, lives on her own, not mom and dad are divorced, and she's making, we'll say, roughly $40,000. And I'm like, okay, well, you're on your own, you're paying your bills? Yep, okay, well, you're claiming yourself.
Right.
There's no way mom and dad.
Right.
So I explained to her the support rules and all that, and she goes, okay. So we start doing the return. She gets a text from dad. Make sure you tell your person that you're claimed by somebody. And I said, well, you can't be claimed. Well, he's telling me, and I shouldn't ask. He said, don't ask any questions either. So I do the return, and in the meantime, I'm like, do you have your 1098-T for your college? No.
My dad's got it.
No. I don't know. Never got it. I don't know. I said, Dad never asked you for it? No. So we went onto a website, grabbed her 1098-T, and she was going to get $3,300 back from the federal and the state combined. Her return rejected because Dad already claimed her. So she called me and said, yeah, Dad's going to make me whole. How much money does he owe me? I said, well, Dad can't claim you. But I said, well, tell Dad he owes you $3,200 because what she would have owed the federal and the state would have been. And she goes, oh, what? So, I mean, it's a big difference. I know we normally say, parents, make sure you claim your kids.
Right.
But you have to be able to back that up.
Right. And the reason he can't claim you, let's face it, he did claim her. And the only way that this is going to be overturned is if the IRS audits that return. And then they would say to the parent, did you furnish over 50% of your daughter's support?
Right.
Which meant it cost her $80,000 plus to be on this earth last year. And that obviously isn't going to be the case. But this happens a lot where people claim, it's like the first person at the water cooler thinks that they won. But the truth is, if that girl wanted to, she could have submitted a paper return, and then her dad would have had to pay back the IRS.
And not to mention, there's a lot of parents out there that make, he could be probably married and he could make over the requirements for being allowed to claim the college credit for his daughter on the federal. I think for a married couple, if you're doing American Opportunity Tax Credit, it's gone around 180 or it starts to phase out around then. So there's a lot of parents who aren't even eligible to claim the college credit for the federal because their income is too high. But of course, the most important thing is following the letter of the law, and that's what Sarah and Chris were doing. You know?
Absolutely. Well, I don't know if Sarah,
it wasn't.
her dad wasn't.
But
That's
yeah,
for
her
sure.
dad definitely wasn't because she never got the 1098-T. So did he make up the education himself?
Yeah, right.
So.
Okay, what else we got here?
So it says, Ralph from Clarence, I'm retiring this September. I want to be sure I have my Social Security taxes covered. I will have approximately $40,000 in wages, some investment income of $1,000, Social Security of $8,000. I'm married and both of us are over 65. Someone said I don't have to pay taxes on my Social Security. So do I.
Okay, so the computation would
he makes
be
$40,000
the
wages.
$40,000 plus half. Actually, it's $41,000, right?
Right.
Total income plus half of the Social Security, which is $4,000. So that's $45,000, and that's over $32,000 by $13,000. So $6,500 of the Social Security is going to be taxable on top of the $41,000. So that's $47,500 that he's going to have in income, adjusted gross income.
And then over
so yes,
65.
he's going to have to pay taxes on part of the Social Security.
Yeah, the standard deduction for a married couple, both over the age of 65, is what, around 29?
31,000.
31,000. Yeah.
So he's going to have a small liability.
Right, very small. So you also might want to put more into his 401k at his employer, and
He still does have time right now.
so-
Because
Or an
right now
IRA.
he's saying his
HSA.
wages are approximately $40,000. If he were to use the elective deferral,
Yep.
he could put $20,000 into his 401k plan, bringing him down to 20,
Yep.
And then he wouldn't pay taxes on his Social Security. And that's how the law works.
Yeah, and-
so that's why it was a great suggestion.
Yeah,
Tim.
and then maybe even if his wife wanted to put money into an IRA because she could draw off of his wages.
Well, I mean, he's not going to, once he gets under that $31,000 standard deduction, he's
Right.
good. He's good to go.
yeah,
right?
Yeah, and that's where tax planning is so important.
Right.
You're using your knowledge to leverage.
So, Ralph, you have time. Not that he's going to owe a
And
lot
then-
of money. He's probably going to only owe $600 or $700.
And then also the 8,000 was only partial year in Social Security. The next year,
but next year, will he be working? It
right?
sounds like he's
and
retiring.
so you really should give us a phone call. Are you going to keep
Right.
working because maybe this was just part year Social Security, and next year you're going to have a full year of Social Security
Yep.
where it could be like 30,000. And so you really need to plan because there's so many people who get Social Security and then gulp. They have this big tax bill at the end of the year,
Right.
and it's something they didn't plan on.
Absolutely, that's great. But here's the thing: if you think about this, if you put some money out of your paycheck for the rest of the year into a pension plan, that eliminate taxability altogether. And if you say, well, I don't care about saving $700, but if you remember, you still have that money, that $10,000 is still your money plus $700.
Right. That's
So,
right.
and actually, if you bring it low enough, you might qualify for the pension savers credit, right?
That's a really
So-
good point. Really good point.
All right, because there's all these little things that are hanging on the tree.
Very good idea. But Social Security is a wonderful thing. And then, this also ties into, I know we're running up to the end of the show here, but should you wait to collect your Social Security or should you start getting it right away? And so it's something we answer.
Well,
so give us a call.
sounds like he's going to start collecting right away.
Yeah. But if
Right.
there's other
But
listeners.
it doesn't. I will have, it doesn't. He doesn't. But we're married. But he doesn't say anything about his wife's income.
I thought about that. I was assuming
So
there was none.
what we're saying was based on his.
Right.
If they file joint, we got to know what her income is. What is her Social Security?
Well, I mean,
Is
let's
there-
face it. When we're doing these radio shows,
It's hard.
we're giving you answers based upon what we can speculate. You would never do anything until you sit down with somebody and make sure that this pertains to your situation,
right.
because taxes are complicated.
Right. And I know from helping people over the phone too, we try to ask all the questions and we'll say, well, what is your income? And even though they're married, they only give us their income
And not their spouse.
because we said yours.
Right.
And that they took it as just theirs. So
Right.
you have to be open to get the correct answer.
Right.
Hmm?
Okay, what else we got?
So I've got Wilma in Marilla, a tax lady. My husband and I have purchased a solar roof. After rebates, we have to pay about another $40,000 for the system. Since we are both retired, our only income is pension of $20,000, Social Security of $4,000 for both of us. The solar people said we should get this big credit. How do we go about getting the big credit? no liability.
There's no liability, which
Yep.
means no credit
Right.
on either the federal
And you have
or
to
the
really, when a salesperson is selling you snake oil and promising you big things, and you have no tax liability, that solar credit is going to save you zero because it's a non-refundable credit. But they could generate their own income, couldn't they?
Right. So how do they get their big credit? Take the money out of your 401k or
Or your IRA. Right. Hopefully you have some money in your 401k or IRA.
So what is, if they have that and they do that, what is the credit up to on the federal and the state?
Well, the federal's a 30% credit of the 40,000, so it would be a $12,000 credit.
And then
New York State is a maximum of up to a $5,000 credit of 25%.
But again, it's only if you have tax liability.
Correct.
So this couple just might want to say, "Gee, maybe we should take $50,000 out of our IRA." Why would you do that? Because it's taxable, but then that credit covers the liability. So in essence, you're not paying taxes on that money at all.
Right. That's right.
Yep.
Planning.
Planning. Okay,
Yeah.
what else we got?
You got one, Chris? Or name withheld?
We have to do it quickly.
Okay, I got one, Alex. Esther, I just had new flooring put in my house, and the contractor gave me a form and said it is to save for tax purposes. How much of the $15,000 will I get back from my
Oh,
flooring?
I love this. It was a capital improvement.
Correct.
What is a capital improvement?
It just means that you don't have to pay sales tax on the material.
Right. And so people think that they got a big, we
Credit.
put in new kitchen cupboards and we got a capital improvement. It just means that it's affixed to your home. It becomes part of the asset of the house. Therefore, no sales taxes are due.
Right, but don't forget this is part of your basis, and so it's part of your story, and so it increases the value of your house. So if you ever have to calculate and back into that
but
basis,
there's no benefit unless it's energy conservation.
Right.
Right?
New windows, doors, furnace, air conditioning, hot water tank. That will-
Insulation. Right.
Insulation,
All right.
yep.
I'm Esther Golias, the tax lady from EG Tax. Thanks for listening. Next week, we're going to be back with some more of our emails because we have tons of them, and we hope that you find them interesting. If you need us during the week, you can get us by going to our website at egtax.com. Call us at our corporate headquarters. The phone number's on the list. And don't forget Tax School and our seminar. And thanks for listening. Have a great weekend.
The previous program was paid for by EG Tax.